Good morning, good morning. Just gone 8:40 guys on the 9th of November. I just want a quick test if you can see my screen and if you can hear my voice nice and clearly. Please type a Y. And give me a Y for both. So just in the new room and in the main room actually. I'm got no Y's coming through. Okay, excellent. Well, good morning. What a shock that was to the... Well, that's not so much of a shock, but what a confirmation move that was on Friday. I'm going to start by going over the main non-farm payrolls figures for Friday and just how now assets have moved after that thump of a number. So the actual figure released for non-farms on Friday was 271,000 jobs created in the non-agricultural sector, prior revised also up to 137. So you not only had a beat on the headline, but we also had a higher revision from last month's figure as well. One thing I'd like to say about that is, this non-farm payrolls figure, it is a poll. It is, these numbers are created by asking people within the industry on their views and on their numbers, and you do get mistakes in this area, and therefore you do get anomalies. And the main driving factor now with this non-farm payrolls number is the long-term trend of continued employment growth is still firm, is still in place, and it looks more and more like the September number was an outlier rather than sort of a new normal. The difficulty was the bad September number came after a couple of bad numbers, a couple of misses beforehand, but the strength of this number coming in at 271 really, it's like a reversion to the mean, isn't it? If you have a player in basketball that has 4 off games, then that 5th game he might be more likely than not to actually outperform his recent games. Strong number out of non-farms, but it wasn't just on the headline rate, it wasn't just on the revision rate. I mean, the unemployment level in terms of the 5%, that obviously came out in line, but it was the average hourly earnings that was the big mover here as well. So that was expected at 0.2%, and it came out at 0.4%, so double what was expected on the average hourly earnings. Now, this is really important for the Fed because they have to move. Being a central banker, you have to move before you see inflation obviously fully impact the economy. And there's about a 6-month delay, apparently, that they say that it takes for a rate hike to impact an economy. And so if we're starting to see an increase in average hourly earnings, then it does give the Fed the green light to move now. And on top of that, the Fed have been desperate to move. And I think that was really communicated strongly by Yellen 2 weeks ago now in her tone of language and how committed they were to move should the data even begin to allow them to do so. It's been a very different tone out of the Fed though in terms of the global international environment. And this is where I see a bit of a problem here. I'll go over the asset moves after non-farm Fridays in just one second, but one of the big shifts in Yellen's communique has been that she neglected to mention last time she spoke the concerns over the international environment, concerns over the strength of the global economy. About 4 days later, Mark Carney and then Draghi's ECB both highlighted their concerns over the strength of the global economy, saying that actually their concerns had increased. So it does seem a little bit worrying that the US have now a very different view to how everybody else sees the rest of the world going. We have had more Chinese data come out, and again it's disappointed. We're not getting a huge amount of growth there, but also the biggest danger to the Fed, the FT did a good report on this morning. What could stop the Fed from hiking in December could be if you see a large... no audio, 1 minute. So one of the concerns that the Fed are going to have is and you saw some moves on this front on Friday after that non-farm payrolls figure, if the move out of emerging market currencies is really sort of takes builds up in strength and really damages that outlook for global growth, then the prospect of the Fed hiking in itself could actually prevent them from hiking. That hasn't happened yet, and it may well not happen. And really, if the Fed managed this process well, it shouldn't happen. But just in terms now, it's more likely than not that the Fed will hike in December. That number, the payrolls number, has certainly helped them in that remit. Perhaps the only thing that might stop that is then if you see, the negative reactions to Friday's figure taking over the positive impetus of the wage growth and the employment number. For example, oil fell 2% on Friday. The dollar was up 1.3% versus the euro. You had the emerging market currencies like Russia, Colombia, Poland, Turkey, all trading at one point close to 2% down on the day, and that's the balancing act that the Fed now have found themselves in, and perhaps the only thing that might stop them from hiking in December. Now, it's not just the hike in December that's the interesting part of this, but just looking a bit further out, it's now priced as 60%, according to Deutsche Bank's read, 60% that you'll get a second hike by June next year. So this is the interesting one. What Bill was talking about in the room to you guys over the last week or so was the possibility of a dovish hike. And what that meant was still hiking in December, but with enough commitment to not hiking within the next 6 months that actually, even though they did hike, the market could take it as a dovish signal. So it's interesting now to see that the 60% likelihood, according to the Fed funds rate, 60% likelihood that we will see a second hike in June. But the bottom line is this was exactly the number that the Fed were looking for. This was exactly what they would need to be able to push the button and at least start moving away from zero rates that we've been for 7 years or over now. Not just in the US, but once America start this path, will it help perhaps the Bank of England try to move to some kind of monetary normalization? It might help all of us if that was to be the case. So let's have a look at these assets then. Well, firstly, let's look at gold here. I'm out of those gold longs, and as I said if it goes below that 150 handle, that was signal one, and the second one was the level here, 1133, which was the low there back at 2014. Can you see where I've highlighted that on my chart, the 2014 low? Clearly, this is now a new trend. This is now a trend of stronger dollar, yet still potential low inflation, and that both of those things not being good news at all for gold. And I think very much you might see the $1,000 handle being reached. So I'm out of all of those gold positions. Again, it's one of those ones. Not a particularly big losing trade at all. In fact, I've bought and sold gold a number of times, but now's not the time to be long gold. Just you have to be able to move when the fundamentals are so strongly against that. So let's have a look at the dollar. Well, this is the euro versus the US dollar. Obviously on Friday, we were already quite heavily down in the euro versus the USD. So here's Friday's candle. Lovely testing the high of 1.0904. That was the low. So lovely classic trade there. That was the low on the 28th of October. But we came back to test, and then just moving all the way down to 107.03. So for you dollar bulls, it looks like parity now might be on the cards, but be careful for what you wish for, because parity was the big call that was being made all throughout early 2015. Do you guys remember that, when this dollar first started? Oh, look at this run in the dollar here as people are expecting the Fed to move in rates all throughout the end of 2014. We don't get a hike in March, we don't get a hike in June, we don't get a hike in September there, and we're going all the way back now to 1.17 in the euro versus the USD. But it's very much looking like, especially if the ECB are able to follow more dovish policy now, parity is now a more valid thesis after the communique from Yellen and after what we've seen out of the ECB. So I think parity in the euro USD more a valid thesis now, but it was being priced in January and February this year with extreme confidence. And had you have traded that view, obviously that would have had you would have struggled immensely holding that position on the Euro USD. So dollar strength, gold down, T-notes obviously now on the back foot as well. So US government bonds here, let's just have a look at T-notes. We're trading down to the levels seen June or July. The one thing here that actually, I was looking at analyst notes this morning, and there's quite an interesting viewpoint in what do you invest in now, what do you trade in, what's the trade given Yellen's new stance. And quite an interesting angle was on long dated bonds, and one of the reasons being that, well, if they don't hike, then obviously the lack of the hike will now support bonds at these prices. Or if they do hike and that hike is seen as premature and creates uncertainty in the financial markets, then your position in long bonds might be supported as a flight to quality. It's just interesting to try and think about, imagining you're a long-term macro trader, how would you be able to position yourself now? Another long-term trade idea might, for example, be in inflation-linked bonds. If you think that the low oil prices aren't here to stay, it's really all about oil prices. If you think that eventually oil prices might move and you want to be protected against inflation whilst all of this loose monetary policy is still in the picture, I mean, this is quite a long-term game because there's little inflation at the moment, although the US was just starting to see it out there. Then inflation-linked bonds might be an interesting one too. Just on that oil news, we had comments coming out from Saudi Arabia over the weekend. Whilst we talk about oil, we're trading at 44.42 now. They are committed to continuing to meet their supply targets. They are not in any way looking to reduce their expansive production. And here you have Mr. Fali, who's the head of Saudi Aramco, also the head of the health service over in Saudi Arabia. Busy man. Says that for high-cost oil producers, the $100 oil was perceived as a guarantee of no-risk investment. Now, the insurance policy that has been provided free of charge by Saudi Arabia does not exist anymore. It's not exactly bullish commentary for the oil market. And just a note to put into your calendars, guys, it's December the 15th that we've got the next big December the 5th that we've got the next big OPEC meeting. And with comments like this coming out of Saudi Arabia, it doesn't, to me, sound like they're going to change the new status quo too much. One thing he does say is this is the head of Saudi Aramco again: we knew this was going to be painful, but the extent of the pain has gone beyond our expectations. He says the market has overreacted. Now, one of his theories in terms of why he can be quite calm in terms of their market share strategy here is that he says, and I quote, "We will be vindicated in 1 or 2 years when global growth has revived demand that swallows the global glut in oil, and prices will begin to recover." So this strategy that the Saudis are playing is on expectation that in 1 or 2 years, a recovery of global growth that higher demand will now meet the needs of supply. One moment, if my mic's gone, testing. One moment. I'm going to have to log in again.
So